Hey guys, welcome to the third episode of Capital Wheel Trades. In the previous weeks, we talked about selling a put and we talked about selling a call. This week, we're going to talk about the wheel strategy, which is a combination of selling a put and selling a call. So when you sell a put, you always collect premium. After the first week, your put is either not exercised and you can do it again the following week, or it is exercised, meaning you own the stock and you now own 100 shares of the stock because your put was exercised at the assigned strike price. So if you own 100 shares of the put at the strike, you now go down, and this is the beginning of the second week. So now, since you own 100 shares of the stock, you are able to sell a call against your stock position, meaning you still collect premium like the put. So if you are exercised on the call, your stock is sold at the strike price of the call. If your call is not exercised, you can do it all over again, like the put example up here. So if your call is not exercised, keep doing this over and over again. If your call is exercised, meaning you lose the shares and your stock is sold, then you just go back to the beginning, and this is the wheel strategy.
Okay, we showed you how the wheel strategy works. Now we're going to walk you through a specific example. And here we're using the ticker symbol ONON, on holdings. So this is a trade that we actually made in January where we sold a put and sold a call and collected the premium on both. So on January 22nd, we sold a put for $13 collected premium. The strike price was $26.50. And for that, we had to put up $2,650 of collateral. So it's the $26.50 strike price times 100 shares per contract. So we had to have $2,650 available to buy the stock if it was exercised. So the return in that first week was $13 divided by $2,650, 0.49%, 0.5% return in that first week. So at the end of that first week, the market price went down to $26.25. So because the market price of $26.25 is below our strike price, we now had to buy 100 shares of ON holdings at the strike price, not the market price. We had to buy it at the strike price because that's what an option is. So we bought 100 shares at $26.50. We used our $2,650 collateral. We bought these. So now we own 100 shares of ON holdings. Those 100 shares are valued at the market price, which is $26.25. So we actually lost 25 cents on the value of those shares, but now we own the stock. So the wheel strategy allows you to continue to own the stock until it appreciates back up to your original value, and so you lose no value on the underlying stock. Okay, so we're at the end of week one. We own 100 shares of ON holdings. So the beginning of the next week, we sell a call. So on January 29th, we sold a call at a $26.50 strike price because we want to get back to our original price so we don't lose any value in the stock. We sold at the strike price of $26.50. The premium we collected that week was $48. Again, we own stock that we paid $2,650 for. So our return that week was 1.81%. So week one, 0.5%, week two, 1.8%. The average over those 2 weeks was 1.15% per week, which annualizes to 57% a year. A very, very strong return. So we're sitting at the beginning of the second week. We sell our call and we go through the second week, and at the end of the week, the market price for the stock was $27.70. So that's above our strike price. So when the market price is above your call strike price, you must sell those shares for the strike price. So we sold those shares for $26.50, same price we bought them for when we got into the trade, so we didn't lose any money on the stock. And we close out the week owning no stock, having lost no value on the stock itself, but making a 1.15% return per week on the $26.50 we committed for that 2 week time period. So that's an example of how the wheel strategy works.
Okay, so previously we went over an example of on holdings where we held the stock for a total of 2 weeks. We sold a put in the first week and we sold a call in the second week. And then we were exercised out of our call and we no longer held the stock. Here is a different example with XP where we hold the stock for a total of 5 weeks. So I'm going to go over this example. It's similar to on holdings, but a little different. So here, similarly, we sold a put on February 5th. We collected a premium of $23 for entering this contract. We had to put up a total of $2,500 of collateral because the strike price of the put contract was 25 and there are 100 shares in one contract. So 25 times 100 is $2,500. In the first week, we collected 0.92%. Ending price after the first week was $24.95, which was below our put strike price of $25. Therefore, we had to purchase 100 shares. In the second week, we sold a call on our stock position and received $63 for this, still using our $2,500 collateral. This return is 2.52% in the second week. After the second week, the market price expiration was $24.87, still below our strike price of $25. Again, we sold a call for the third week on 2/23 for $46 and collected 1.84% on the same $2,500 of collateral. After the third week, the expiration price was $24.03, still below $25. As you can see, we can continuously do this until the stock price reaches $25. On the fourth week, we entered a position on March 1st. We collected $34. We got a return of 1.36%, and the expiration price after the fourth week was $23.91. After the fifth week, we entered a position on 3/8. We got a premium of $13 on the same $2,500 collateral. Our return in that week was 0.52%. And finally, we reached $25. We hit $25.01 after the fifth week, which is above our strike of $25. So at this point, we got exercised out of the call on March 8th at our $25 strike, and we collected our premium throughout these 5 weeks, and the total return, the average return between these 5 weeks was 1.57 per week, which annually is equivalent to 78.5% per week. So if you guys have made it this far in the video, you are probably pretty interested in implementing the wheel strategy for yourself. So here I made an Excel document for you guys to track your positions. I use the same exact document to track my positions and the return I get each week from both selling puts and selling calls. So as you can see here, I'm scrolling through. It tracks your profit, your position return, the amount invested, the percentage of your total you're investing, and if it was exercised or not within the given week. It also tracks your total profit, your total amount invested, and your ROI in that given week. Heading over to the second sheet here, we have another sheet that tracks your calls specifically. So if you end up holding stock for multiple weeks, as shown in the video previously, then you can use this format to track your calls. If you'd like a downloadable copy of this Excel, then comment wheel below and I'll send it to you.